Hi, I'm Martin Shkreli, and this is April 23rd, 2016, and this is lesson on RealPage, amongst other things. So before we get to RealPage, I've actually updated the PowerPoint that I use called Investing Basics, and I've sort of slowly added to this over the course of about 5 months, and I've added some new pieces to it. So I'll upload this after the lesson is done, but we're up to 50 slides, and I intend for this to be kind of a large document that I put a lot of my sort of learnings into, and you can review. So it's sort of structured right now in 3 or 4 segments. So the first is just sort of personal planning and career development, things like that. And I added a few slides there, and I'll go through those. Then there's kind of the meat of it, which is about investing. And most of it's about investing in equities. Excuse me, I have a cold here. There are allergies. I just got a new cat, so I'm very allergic to her. So anyway, most of it's about equities and how to analyze equities. I'm going to add a section about bonds. We're going to get into corporate bonds and sovereign bonds and things like that, municipal bonds, talk all about that. And then there's about 10 slides on markets, funds, and portfolios, portfolio construction, things like that. Then there's an introduction to Wall Street, and then a bibliography that I encourage you to read. So anyway, we've gone over a bunch of these slides once or twice, but one of the things that I wanted to add is this slide, and it's sort of supplemented with another slide. But basically, my theory is that, and this might sound a little ironic, I think people, everyone just sort of has a natural tendency to want to participate in investing. But the reality is that most people should never invest their own money. And the reason for this is that it is a zero-sum game, and there's an old adage when it comes to poker that if you can't spot the sucker at the table, then you're the sucker at the table. And the concept applies here as well. I think that the idea that individual investors can invest in the stock market and expect any return at all, including especially a positive one, I think is a little silly, because it is a zero-sum game. It's a very difficult game to succeed at, and you'll most likely lose. So that doesn't mean that you should despair or be depressed or sad about that. The reality is that you should focus on creating wealth in what you're good at, and not try to be good at investing. If you're in real estate, you can become a billionaire doing real estate. Look at Donald Trump. There's no need for you to become a great investor. It's sort of like when Michael Jordan, who's an incredible athlete, tried to play baseball. He was really good at basketball, and the difference between baseball and basketball isn't that great. I guarantee you that the difference between whatever you're doing for a living and investing is far greater than baseball and basketball. And even then, one of the greatest athletes ever couldn't even make it into Major League Baseball. So I think that if you focus on what you're good at and make wealth that way, you could do great. I mean, even musicians can become very wealthy. Directors, any line of work, if you excel and become the best at it, you can become very wealthy. There's no need for you to try and waste your time investing. And invest with other. You can give your money to a successful investor. And again, maybe someday I'll talk about what to look for in an investor. But the idea that one would want to be a professional investor, I think, is something you got to think long and hard about. And this series is sort of geared towards people who want to invest for a living. They want that to be their day job. So just keep that in mind. This is a template of a slide that I'm going to eventually do about psychology, and sort of the things that you have to keep in mind as you pursue your career. And that'll be, I think, a pretty interesting slide when I eventually get to it. So we'll describe that when we're there. All right. So I added a few slides here. Let me find them. Here we go. So this is slide 27, and I I mentioned here that watching the news cycle or all the news for the companies that you invest in or want to invest in, your so-called universe, is pretty difficult and very important to do. So Google Alerts is a pretty cool tool that allows you to use these so-called as it happens alerts, which you can set up for your whole universe, and just be aware that you're going to get a lot of emails, and that's part of investing research. It's difficult. There's a lot of work. You just got to do it. But that's sort of one of the ways to keep abreast. The other obvious way that's just simply a must is you have to sign up for the company's alerts on their website. So I'm going to show you how to do that right now. You generally just go to the company's website, and then there's somewhere here, there it is, email alerts. Click that. And you just, I guess, say news releases. You don't need the closing price or anything like that. Okay, and that's all you do, and then you sort of get an email confirming it, and then you click that, and you'll get those press releases from there on out. And that's very important. You basically can't miss the company's press releases as they're issued. That's really crucial. If you're not going to do the Google alerts, at least the company press releases. Bloomberg has a keyword, a function called NLRT, which is news alert, and not many people know about it, including experienced Bloomberg users. I actually think it's pretty cool. Then I have evolved one trick that's kind of neat. You go to your company universe thing, spreadsheet, and you can actually type in this thing called last updated, and I think there's probably some Excel function that will allow you to do this, but I actually do it like this, so you can just do it by hand. You could just type in the last time you updated a model, and that way you could even say you can even sort of find the one that you haven't updated and force yourself to keep all of your models at least 1 week current, and that's kind of or 1 month or something like that. Pick a reasonable time. But if you're investing full time, I think you should be able to keep 50 to 100 models current at all times. Sign up for any sell-side research on the company, obviously. If you have relationships with all the major banks, you'd want their analysts to be sending you their notes on the company, and obviously talk to the company as often as you can. That makes a lot of sense. Okay, so now I'm going to talk about something really important called scale, and this is a really, I'd say, advanced concept in finance. And this is where a lot of rookies, and not just rookies, but even probably your average hedge fund analyst makes a mistake here in trying to value a company. And I think this is sort of where a private equity experience helps quite a bit, is anytime you try to value a company, you obviously have to do your forecasts and think about growth and all that stuff. But one of the things that you have to think about is their operating structure, and I tend to refer to that vaguely as scale. And we can refer to scale as basically the idea that are you spending and spreading a reasonable your costs around a reasonable revenue base, or a reasonable amount of costs around your revenue base. And the concept there is you don't build a company for a small amount of revenue. You don't develop, for instance, in this case, I use a pharmaceutical company as an example. It's very difficult to create a drug company for one drug. You have to build an HR department, a legal department, an IT department, a compliance department, let alone your marketing department, your manufacturing department. You're renting an office, leasing office space. You're doing all of this stuff that is really intensive, and if you had a second product, you would not increase substantial costs. You would increase costs substantially, if that makes sense, right? So basically, that's the nature of scale. A company that has a big infrastructure for a small amount of revenue is not at scale. Similarly, you can there's two ways to sort of get scale, and I call that subscale for what it's worth. So subscale companies can do two things, right? They can gain scale by buying new companies, buying new products, or just growing, or they can get acquired by a company with scale. And that company, really interestingly, that company can take out the subscale costs that the subscale company was spending. And this is a really, really important concept, and I'm going to show you with this company real page how important it is. And we'll talk exactly about what I mean in a second. So the error that a lot of analysts make, and this includes, like I said, this is not to pick on any hedge fund or anything, but top hedge fund analysts that I meet don't understand this concept. Subscale companies will not exist in perpetuity, right? If you have a one company, I'll show you a quick example, I guess. Let's say you have a company, this is, we'll call it Trashy Pharmaceuticals, LLC. And Trashy has one drug, and it's called catnip. And catnip is coming out in 2017. And catnip revenues are going to be, I don't know, $60 million. And the cost to run any like most public companies is, you can't really do it for less than $30 million. And just let's say we'll do it like this: corporate costs $20 million. I've run public companies. I know roughly what it costs, about $20 million for all your kind of corporate needs, and then let's call it product specific costs. And so let's say this is the outlook for the catnip drug. It's going to be a $60 million drug for 10 years, and then it's going to go generic. This is it. Sultans, don't type the same thing over and over and over again. That's really frustrating. So if you think about net income of the Trashy Pharmaceuticals, it looks like it's going to be $30 million a year, roughly, right? And the NPV should be what? Let's say 7%. Let's say it's $200 million. That's a valuable company. My cat Trashy is going to be a very, very rich cat. But the point here is that the corporate costs are not associated with the product. So if you take out these corporate costs, let's just write down what the revenue is, the value is. If Trashy Pharmaceuticals is acquired by Maurice Pharmaceuticals, and Maurice Pharmaceuticals already has all these corporate costs. Maurice has an office. Maurice has a accounts receivable department. Maurice has a legal department, IT department, and he doesn't need to really grow that department based on acquiring Trashy Pharmaceuticals. So you can actually take out all these corporate costs, and you can see that the NPV is actually $368 million, which is almost double that if you included all of the corporate costs related to that Trashy had. Because when Trashy merges into Maurice, all those corporate costs are gone. I already have a top lawyer, also known as a general counsel. I already have a head of IT, a chief technology officer. I already have an office. I don't need all of those costs twice, right? So when I acquire this company, I just need the product specific costs, not the product not specific costs, if that makes sense. So anyway, that's what scale is, and that's sort of the concept that's kind of important here. All right, what else? Eventually, I'm going to do a really cool slide here, which is equities over the long term, and basically that it's not just M&A synergies. It's not really just M&A synergies. That was a little harsh there, Randy. So anyway, I'm going to add this slide that is basically says that stocks don't go up over the long run, which I think is a very controversial concept, and I've been thinking about it more and more, and I've been thinking about it my whole life, and I'm relatively convinced that it's the case. And I'm going to start to try to prove that on paper, and I'll be revealing that work over the next few weeks. I'm certain that stocks don't go up over time, and that anyone who thinks that is more or less a fool. And that's it. So I'll upload this in a second, but that we've grown our investing basics PowerPoint a little bit, and I look forward to continuing to make that a growing living document for all of you. I'm just going to erase this. Lewis, your model has a circular reference, which is making Excel go haywire, which is really annoying. It's in cell Z46, and I hate you because of it. In fact, you have 5 of them or something. And yeah, you have the whole line is circular references. So I hate you for that. Okay. So anyway, this is RealPage. So this is a software as a services company, and one of the things that is interesting about this company is it's basically a business-to-business company. And if you look at the companies we've looked at formally, Yahoo and Stamps, and then informally, which are all these, almost all of these companies are sort of business-to-consumer, or so close to the consumer that they could be considered business-to-consumer. Obviously a lot of these companies are advertising companies or companies that sell advertising, but at the end of the day, their users are consumers. And in the case of RealPage, this is actually truly a business to business. The users are business users, and the customers are business users. So it's really a truly enterprise software company in many ways. It's not an internet company, so it actually doesn't even belong on this list, which is telling. It's software as a service, no doubt, but it's not an internet company in many ways. It's a software. It's definitely more like Oracle than it is a very small version of Oracle than it is a internet company. So we're going to move that into some other area. So anyway, let's talk about RealPage. So this is a company that helps with rentals, any rental property basically. And by my math, they have quite a large market share in rental properties. So a lot of the world's, or the country's, rental properties are managed with RealPage software. So that's pretty interesting. And like I said, they're very much a bread and butter software company. The stock's $21 stock. It's got about 80 million shares outstanding, which makes it a $1.6 billion company. Cash and debt are basically de minimis, so it's a $1.6 billion enterprise value. What I found really interesting is the company is 32% owned by the CEO. I actually really like companies like this. My companies are a lot like this. My first company, I owned about a quarter of it, and my second company, I owned more than that. So it's really important to me when I see a company that is owned by a CEO, majority owned by a CEO. It means a lot of things, and we'll talk about that in a minute. Anyway, I built this model, and I got a DCF of about double the current stock price, and I'm going to go through kind of that scenario and why I think that the shares are sort of borderline between being a long and in terms of us adding it to our portfolio, and also sort of borderline not enough of a return. I don't think the stock could be a short. We'll talk about that in a minute. But I'm still new to the company, and it would take more time for me to feel comfortable enough to establish a position. So anyway, I put down all the revenue, all the income statement. You can see that they've had this really nice growth. One of the things that sort of jumped out at me is that they've had a lot of acquisitions. So it's not totally clear what organic growth is. And so if you look at this quarter, Q214, they grew 1% revenue growth. I mean, that is a very, very low amount of revenue growth. Now, having said that, just on pricing alone, they should be doing better than that. So I'm not sure how much acquisitions are contributing to their revenue growth, and it makes one wonder if there's if the acquisitions are really driving the revenue growth. But we'll talk about that in a minute. But in any event, on average, they've been doing pretty healthy growth, about 13% revenue growth. And they just closed a major acquisition called NWP, which will add about 10% to their revenue base. If you look at the company, it looks like a very traditional software company. They got pretty normal financial metrics. One of the things that stood out to me is that they like to quote EBITDA, but I think that if you look into the company's cash flow statement, they have a lot of stock-based compensation expense, and if you look at how much they've got, $10 million on average in the last 4 quarters, it sort of really obscures net income. Their net income is pretty low, and stock-based compensation is obviously a cost. It costs money to issue stock to your employees, even if they're options and even if they have vesting schedules and all these things. They still cost money. It's a real cost, and I don't like to exclude it. My sort of definition of free cash flow is free cash flow with stock-based comp subtracted. So free cash flow is cash flow from operations minus CapEx, and then I subtract stock-based comp, and I get on average about $6 million of cash flow per quarter. And if you take 6 million times 4 for the whole year, you have 24 million in cash flow. And so the company's trading at 67 times earnings, which you might say to yourself sounds like a lot, a big multiple. How could it be a good investment? And that's sort of where the scale stuff comes in, and we'll talk about that in a minute. The growth isn't anywhere near, companies like a Facebook or whatever. It's only about 10-15% growth. So why would I pay 60 times earnings for 10% growth? And the reality is that the earnings number isn't really reliable. Even though I did a lot of calculations to get to this 6 million, even this number isn't really fair. And this happens a lot when you see companies that, I'll give you an example. Like when you do a PE or whatever ratio on a company that, let's say we'll do Trashy Software Inc. And Trashy Software is a startup company. My cat is the CEO. And here's sort of an easy model. Trashy has this could be a really valuable business, but if you try to use a DCF or PE ratio, you're going to have negative numbers, and you really have to take a scale year. So the best PE ratio you could do is on a scale year like, say, 2022, when the company's established itself, it's growing at a more reasonable pace. It's sort of in a permanent state of reasonable margins and reasonable long-term cash flow. And if you do that, you can see that this is a much more reasonable, you could put a reasonable PE ratio like 15 times and then discount it back to the 6 periods, as opposed to trying to put a PE ratio in one of these years. You're going to have a really hard time doing that. And so you have to sort of think about scale a little bit when you do that. And of course, Trashy outsources. Yeah, Trashy's the name of my new cat. So anyway, I looked at their revenue growth and other metrics for many years, including they like to throw out customers and properties. So they manage, or their software manages 11 million properties, which if you think about it is a really big number. If the average household is sort of 2 or 3 people, the idea that this company's software manages probably 30 million people living in the United States. So it's a good 10% of all people. And then obviously if you think about just rental markets in general, a lot of people live in a home that they own. So if you kind of break that out, you'll see that they have quite a lot of market share. So in any event, the revenue they get per unit that they're managing is about $40 per unit, which struck me as a very low amount for an annual revenue for just one unit. It seems like the software is pretty valuable relative to that. The value proposition is pretty good. So I thought that was a nice sort of smell test. If I was managing a set of apartment buildings, and I had to pay RealPage $40 per unit per year, that sounds like a great deal. So in any event, and the math adds up, right? There's 10 million properties, $40 a property is 400 million in revenue. So they gave guidance of 575, and if you exclude so it's kind of interesting, right? So they gave guidance that they'll do $570 million of revenue this year, and that's 23% growth. But they acquired NWP, and so NWP is going to give them 45 million of revenue. So if you exclude NWP, you could see that they were originally, without NWP, planning on growing 13%, which kind of tells you what they'll grow for the foreseeable future, in a sense. At least that should be the most that they'll grow in the foreseeable future without doing more acquisitions. So that was a good way to sort of derive or think about what their opportunity is, and there's other ways to think about it. They also have said that they hope to have $1 billion in revenue by 2020, which I thought was really interesting because I don't think they can get there without acquisitions. Either way, what you'll see is that I predict that this company will be acquired most likely by Oracle. Oracle is a software company that tends to acquire other software companies. Most software companies, in fact, tend to be acquired. It's a very acquisitive industry. And this is a neat vertical. Vertical is a word that means sort of a subsector or fragment. And this is the real estate software fragment. And in essence, what I think will happen is their G&A, you can see that they're spending $70 or $80 million running their software company. And I think that amount of money can drop basically to almost nothing, just $10 million if they're acquired. And they almost certainly would be acquired. Then I also think that they'll save money and have some synergies on product development. So you can see I have the product development going down by just about 20%. I have no savings in the sales and marketing force, even though they'll probably would save money in sales and marketing. I expect that, just to be conservative, in an acquisition they wouldn't get any synergies on sales and marketing. So I gave them the traditional revenue growth. I have them doing 30% in taxes, and obviously if they're acquired by the right kind of software company, they can redomicile and maybe be able to save further on taxes, maybe down to 25 or 20%. So there's some upside there. In fact, I used to do something right here called tax rate, and maybe I'll start bringing that back in my model. So it's pretty simple. If you just plug it in like this, you can adjust the tax rate yourself. So there's some European companies like Ireland that, if an Irish company bought them, they could be down to a 10% tax rate, which is pretty important. So we'll adjust that in a second. ROIC is really important, right? So this is the idea that I've sort of created, that management will use cash that builds up in their company, and you can see here that the cash building up in their company. I should probably X out the NWP cash, but I think they have $80 million that they acquired NWP for. But the point is, the point is that management will take cash that is building up at their company and they'll use it. And this company, RealPage, has certainly done that. They've done like 20, 30 acquisitions in the last 10 years. And so they're a very acquisitive company. And this because the CEO owns 30% of the company, he's going to be like a bloodhound for creating value. The same way I am at my companies. Because if you own 30%, think about it, he owns 32% of a $1.6 billion company. This guy is worth $500 million. So you better believe that he's working his ass off, as opposed to your average CEO that doesn't even own 1% of his company. He's getting a big fat salary. You can't have enough of a salary to make it interesting if you're worth $500 million. You know, it doesn't matter what your salary is. What you're worried about is getting the stock price up. Hopefully it can be 30 or 40 or 50. In fact, I think it could go to 50. And if it goes to 50, this guy would be worth $1.2, $1.3 billion. That's really amazing. So anyway, the point is that, you know, this guy is very rich, and just by looking at kind of the way that he's operated, I think he's going to deliver a lot of returns for his shareholders. So the discount rate's low because their retention rate is enormous. They manage 25%, I think, of rental opportunities in the United States. And their customers renew at a 95+%. And then I think that the maturity is probably going to be a positive rate, a marginally positive rate. You can make it a marginally negative rate if you want. But I picked 2021. 2021 as the maturity year, which is pretty close. That's just 5 years away. So a small positive rate is pretty reasonable, I think. And depending on the tax rate, if they stay in the U.S. or their acquirer doesn't rationalize the tax structure, you know, you can sort of play with that. The ROIC doesn't shift things a ton. It adds like $5 a share, but I think that makes sense. The discount rate is low, and so I get $41 a share for the stock, and right now it's at 22, so that's basically a double. That's usually good enough for me. So that's sort of the way I look at it. And again, you would not be able to make this work if you assume that they just had their G&A spending, you know, the same forever, because it doesn't make sense that this company would exist just to be a software company just for the real estate market. They should be bought by a big software company like SAP or Oracle, and my guess is that'll be what happens. So it doesn't really matter why I made maturity so early. You know, I could have tried to forecast cash flow more accurately for the next sort of 10 periods, but it wouldn't have made a difference. In fact, I'm being conservative by sort of ending their growth period. This is a smart management team that will probably keep growing. So my guess is this is sort of what will happen. They're subscale with their margins for a reason. And I think it's, you know, they're focused on growth. And a bigger company or private equity could chop at least $100 million out of their cost structure. So I think of the company as a $200 million net income company over the long term. They've actually said that when they hit $1 billion in revenue, they expect $300 million in EBITDA. So it's roughly what the company is telling you they think they'll do. You know, from my perspective, this is an attractive market, and it sounds like their software provides a lot of value add, given their customers just pay $40 per unit to manage really valuable properties. So that's basically where I'm at. Yeah, so the tax rate thing is that I assume they'll be acquired by a company that manages their taxes better. This is a company based in Texas. They don't really pay taxes, as far as I can tell right now, so I don't really think it matters. But over the long run, if SAP acquires them or some other company acquires them, they'll put them in some weird domicile, and then all of a sudden they'll be fine. So they don't really have any competitors, is the way I look at it. They have such a big installed base that, you know, they own the market, is the way I look at it. And R&D will grow, and I have it growing at a pretty healthy rate. But R&D isn't really, it's just product maintenance in essence. So anyway, that's sort of the way I looked at this model. I think most CEOs that own 30% of their company, this is the only way for them to monetize. Like, they want to get rich, so they'd love to sell the company. that's sort of like a key thing for these guys. So anyway, let's look at some of the models that people made. So that was pretty fast. So in half an hour, I got through all of that. So this is just from Louis de Maria. He makes a thing called recap, which is nothing, not my preferred style. In fact, I found this revenue breakdown hidden away in an appendix that shows that they 30% property management, 30% resident services, 25% leasing and marketing, and 10% asset optimization. I think they can hugely increase their ARPU. And this is not uncommon, by the way, in software as a service. When you have a subscription model, you have a low ARPU because what you really want is subscribers. And then eventually you can turn on the services and make them premium. And Netflix is a good example. I want to short Netflix, and I'll talk to you guys about why. And maybe we'll take an investment committee vote. It's Steve Wynn. It's not the Steve Wynn. It's a different Steve Wynn. So anyway, I think they can really grow their ARPU quite a bit, and get to their $1 billion forecast pretty easily. In which case, the stock could be even worth more than $40 a share. So anyway. Yeah, I mean, these guys don't have inflated subscribers. They just got their property management. Might be inflated. Who knows? Anyway, let's go to Louis de Maria's model. So he doesn't use my format, even though it's pretty important. And for instance, if I didn't know that their software does so many different things for their client, I'd be a little less excited about the company. But they're actually pretty diverse within their service offering. And that's because they've done so many acquisitions, I think. They really have broadened out what they're trying to do. You can just put shares in millions. I don't see why you would put it in thousands. So that doesn't make a lot of sense. And this should be right adjusted. And then there should be no spaces between these. I mean, if you look at all of my models are available online, and I don't understand why you can't just copy my format. It's not that hard. And then cash is, you said it was 30 million. I said it was 116. I think you probably excluded the restricted cash, which is fine. I'm not going to debate that. All right, RealPage has grown in the past year through acquisitions and will continue to do so for the foreseeable future. So they're growing without acquisitions. But they definitely are enhancing their growth with acquisitions. Introduces a highly fragmented market. There's a user-based company monetizes users at $43 a year. It's not really users, it's more properties, but I get your point. It generates a lot of cash. They don't really. That's the interesting thing. If you look at the free cash flow minus just free cash flow, I guess, it's positive. And you're right that cash flow is higher than net income. Like if you look at cash flow here, it's way higher than their reported net income, right? Here on average, it's $24 million a quarter. But if you look at the CapEx, it's $8 million a quarter. So, it's definitely more positive, right? 63 million in free cash flow. But stock-based comp, it's not cash, but it's dilution, so it counts. And so if you ignore stock-based comp for whatever reason, which I think is a little crazy, it's 20 times earnings, 26 times earnings, but you're ignoring a key cost. So I don't know that I totally agree with the cash generation concept. I don't think the rental vacation market concept is that's where their growth is. Most of their properties are not that. Most of their properties are just apartments. I don't think Airbnb is a threat, because Airbnb is really a consumer product. All right. You tried to make... okay, here it is. I don't really understand what you're doing here, but I'm going to give it a shot. I don't know where you got this information from. It'd be nice if you quoted where you got it from, because otherwise it's too hard to know where you got that information from. And I wouldn't focus on competition that much. So it'd be good to know where you got this ARPU number, but obviously, you know, there's a potential, definitely a potential for increased ARPU. Yeah, I don't agree with how you built your model on revenue per TAM. I think that's kind of crazy, maybe even silly. Does it really make sense? They're telling you it's an $11 billion market, but that doesn't mean anything. Really doesn't mean anything. I don't know why you're bolding gross profit, but God bless you. You just put in 10% revenue growth forever. It doesn't really make sense. The scale thing you ignored as well. So your EBIT, like this doesn't make any sense really, this model, because you have them. I mean, think about it. You have them going from a $500 million company to a $2 billion company, and their margins don't go up. That doesn't make any sense. The whole point of growing your revenue is to have even higher margins as well. So that's a really, margin expansion is just sort of basic idea. You even margin expansion, expand, grow. All right, so I give you a D. This margin expansion is pretty obvious. You're going to have a lot higher margins when you're $2 billion in revenue than a $500 million in revenue company. That is pretty obvious. Let's see. Net present value. You don't have a maturity. You don't have a perpetuity terminal value, which I don't know why you think the company ends in 2030. Like, do you think is that the Mayan end of time? What happens in 2030? Aliens? Aliens are coming? Drones? Doesn't make any sense. Talk to the CEO and say, what do you think is going to happen in 2030? Do you still think people are going to be using your software? Obviously. And then your tax rates are all messed up. You have negative taxes. I want to know what country that is. Negative taxes? Cool. Alright, so this was maybe it's, I don't know. I'm done with this model. Circular references killed it too. What a bum. That was a bum ass model. Put some respect on it next time. Alright, Pavel. Nice, he's got the CEO. I love Pavel's models. I'll try to upload the videos earlier. I'll do my best. I like how he puts the CEO's picture there. That's do you trust this guy? What do you guys think? Yes or no? Do you try? That is the grade. It's a bum ass model. Bum ass model, or just bum ass. I think is fine. Do you? Oh, you did do a terminal value? I don't know. Your garbage model is not even worth looking at. You trust this guy? He looks very Texan, I will say that. Very Texan. There are some comments on Glassdoor that you know management doesn't know much about tech. That's not uncommon. Larry Ellison doesn't know shit about software. Enterprise software is basically, it's funny. CEOs of enterprise software companies are like very salesy, very like salesy. Think about Larry Ellison as the king. Steve Ballmer, like these guys are born salesmen and they're like terrible technologists. It's pretty funny stuff. And he seems like a very basic enterprise value company CEO, enterprise software company CEO. He owns 30% of the company, which means he's extremely rich. He's half a billionaire, and he's going to take care of the company, I think. Anyway, this is nice. 32 acquisitions exactly. 46 million rental units. I thought it was interesting that they had 440 reps. Like that you got the 32% thing down there. This is good. I like this. I like that you put the stock incentive plan in here. I don't think they've got 26 million shares in the plan. You spelled incentive wrong. But definitely, maybe thought that could be how many they have authorized, but I think they only have about 5 million options. Maybe more, I don't know. 26 sounds like a lot. You got the goal, that's good. It's all very good. Good modeling. Good note taking for sure, Pavel. 2015 revenue was 58 million. And so they expect, it just closed. So let's actually do the math here. So it closed, so 58 divided by 12 is 5 million a month. And if they were going to grow 58 from 58 million, let's say they were going to grow 5%. So they would have had 61 million for 2016. They closed the acquisition on March 7th. So they're going to get 10 months. So they said that they expect 45, I want to say, from NWP, but they closed the acquisition a little early, right? So they're going to probably get closer to 50, which isn't enough to really quibble about, but that's pretty good, Pavel. Cloud solution is a problem for some companies? Yeah, I don't know. I think that's probably not the case. Yardi? Huh. I like that you looked into Yardi. I don't know anything about Yardi. Very nice, very nice. It's one of the better front pages I've seen. Beautiful. And look at the model. It's exactly how I like it. I'll be right back. I'm gonna get a soda. Another soda. Joshy. My cat is very shy, so. Alright. Let's see here. Now the important stuff. It's weird, you bold gross profit, but you don't bold revenue. Revenue isn't more important, come on. Don't bold too many things. The only thing I like to bold is revenue. I like this. Goal is 1 billion in revenue. I don't think so. Wow, Pavel, you got some respect. Put some respect on it. Only if they buy more companies. That's what I think. I think this is interesting. How do you get this? How do you get them 3, then 15, then 5, then 1, then 6? That's pretty weird. You have the maturity -2. That's, I'm not going to quibble over that. 6%. I'm not going to quibble over that. This is weird though. They have 80 million shares outstanding. Not 17. So pretty bizarre. This is Pavel. That's kind of bizarre. Yeah, I don't like this kind of forecasting, just 18% of revenue, because it doesn't imply that they'll gain any scale. Like if you look at the margin, operating margin, you have them gaining a little bit of scale. Not much. Wait, what's this? This is not. Operating margin is operating income divided by revenue. Poor Pavel. And you only have them going to 6% operating margin in a $1 billion company. That doesn't make any sense. So you did a lot of things wrong here. C minus. All right. Yeah, some of this stuff is just silly. Like, you're telling me the stock is worth $4 a share, basically. Because you put in the wrong number, which is really embarrassing. The stock's worth $4 a share. It's trading at 21. Why isn't it the greatest short ever? Why aren't you begging me to short the stock? Dumbass. I will say, if you guys come up with a really good stock pick, and you say, hey, Martin, I got a really good stock pick. Here it is, and it works, and I make some money, and the next time you come up with a really good stock pick, and I say, all right, I'm going to put $5 million into it. And you say, that's good, because you're going to double your money. It's going to go to 10 million. You're going to make 5 million. And as part of the deal, because I want stocks like this, and you gave me your first stock pick for free, and it was really good, this time I'm going to pay you 10%. That's 500 G's. This isn't a joke. This isn't a game. You're talking about being a franchise player, and you're asking about practice. No, it's not practice. I'm trying to find a great stock picker. Talking about practice. All right. Ben Goldstein, this guy's crazy. Introduction. I was watching your stream the other day and was tripping on acid. Okay, interesting. Thinking about a theory on stock prices. Playoffs. Thinking about a theory on stock prices, which I wanted to throw your way. I've since gathered my thoughts into this one Excel spreadsheet for you. Personally, this is going to be relatively on me, but it will be hard for you to understand what's going on there. Sheets out, at least skimming this over. My theory began with the observation that you can split investors to 3 very broad groups. First, investors understand the stocks you're buying a portion of the company. Second, investors which deeply see stocks and other the company. Third, being you. And now your viewers who appreciate the difference between the first and the second set of investors and wish to exploit this. Woo. Okay. Let's see. My theory. Firm performance is a function of stock price. Yeah, this isn't the first time someone advances this theory. Soros wrote about this a lot. By the way, I don't think it's true, because there's private companies like Koch Industries that have done just fine. Not every company is public, so the theory is kind of moot in many ways. The Goldstein Equalizer? This guy's naming stuff after himself? Come on. The entire model is dependent on a random number generator. GBM. No business knowledge is required to forecast cash flows. A state of pure phantasmagoria after judging this process. He has a poem. A poem. This is definitely the most unique model I've ever seen in my life. All you need to do is input some information. Theoretically, instantly. I literally do not know what RealPage does. I don't know what it sells, how it sells, or to whom it sells. And to be frank, I don't need to. I've never heard of them before. And apart from and other tickers in my stock portfolio, I doubt I'll give a second thought to them. Yet I created a near perfect model. Oh man, this is amazing. All right. Let's take a look. Math stock predictor. RealPage stock price estimate from 2016 to 2031. Here I'm going to simulate 15 years of daily stock price using geometric Brownian motion, GBM. I use this part of my video to the random walk segment to estimate stock price as well as for predicting revenues. Amazing. Cool. Brownian motion, huh? You know what's interesting is he does arrive at the same fair value as I do. Stock price last reporting period. And you can see revenue has no... The cluster illusion. These numbers aren't even right. Oh, wait, hold on. No, they are. It's actually pretty accurate. Discount rate's high, that's why. Okay. All right, my rating is you are definitely on acid. No need to test. Akil, is that you? That wasn't yours. I wouldn't say it's disappointing, but it's definitely one of the weirdest things I've ever seen.
All right. So here's my email. I got a lot of models. I just got one literally half an hour ago, which I don't understand why you think I would want to look at your model from half an hour ago. All right. Averill, Young Desi. Averill, okay. Again, the decimals, but in principle, fine. Company provides software, saves time, money. That's the idea. This formatting is terrible. I mean, these numbers are impossible to look at. You don't have any. You put 5 quarters. Like, where's all of 2014 and 13? You don't have anything for 2016. This is garbage. Just, put in one line in front of there. Use some formatting. Jesus Christ. This is equivalent of like Times New Roman in like 6-point font, where with random spaces every other word. Sometimes you use single spacing, sometimes you use double spacing, sometimes you use triple spacing, and sometimes you start a new page in the middle of a sentence. That's what this is the equivalent of. You wouldn't do that in Microsoft Word. Piece of crap. At least you get that a company's margins expand with time and with success. That's useful. You put the 35% tax rate. I think you sort of missed the point, though, that the margins will expand way more than they're at now, and that the scale that they have for it's interesting that you combine SG&A, but sales and marketing and G&A are very different ideas. Let me just double check that there was no primary research, but that was pretty crappy. Like, you don't even explain why you think revenue is going to grow at all. Yeah, terrible model. All right. Try this guy, Rick. Yeah, I don't think you should model based on what the company tells you to model. I think it has to be realistic. Wow, look at this trash. 2016, where's the numbers? You don't feel like forecasting the numbers? All right. I don't feel like giving you a job. How about that? Dumbass. Okay, revenue per customer. Well, why are customers growing 5%? What if customers stop growing? It's reasonable to forecast it this way, but you don't assume management ever takes the money and does something with it, which is pretty dumb. Margin thing, it looks like you get the margin thing better than most people did. So far this is the best one, but it's not very good. You put the balance sheet on a different... All right. So this was Rick B, maybe a B minus. No ROIC, not much primary research. Let's get this one. All right, you're all zoomed in. It looks like you're zoomed in for whatever reason. I don't know why. This is disgusting formatting. This is good, but you didn't have the breakdown by revenue. I like the Glassdoor thing. This is really nice. Nice touch on the, this is good diligence. Charlie Munger quote. Wow, you're really trying to get your grade up. This guy. Again with the zoom. Just keep it at 100%. Christ. My eyes aren't that bad yet. No cash flow model? Yeah, sort of a cash flow. One line of cash flow. A little lazy. Yeah, you just pick 15%, whatever. It's all good. They'll grow 15%. Margins? How about margins? Yeah, you don't have much margin growth. It doesn't make a lot of sense. You don't double your revenues and barely grow your margins. It really doesn't make sense. Nice due diligence from a message board. I mean, that's the kind of primary research I like to see. You know, he go into a website called multifamilyinsiders.com, and he has this testimonial versus their competitor Yardi. Really impressive work right there. That's what you need. But he sort of fell apart on the rest of it. So pretty good. Yeah, don't put a Munger or Buffett quote. I was just kidding. That's not going to get you anything. All right. All right. Christian. Christian Paleka. What the? Bro. Bruh. Bro. Bro. Alright, let's look at a real champions model. Let's get a real champ. See what the real champ is up to. Super hot fire. The baddest of the bad. Oh, look at that. He's got the IR guy's phone number on the fucking page. What a god. What a god. This is getting me pumped up. I'm like a little tired and sleepy, but spit that. Spit that hot fire. Rhett Butler. Oh my god. You know what? Be the sickest thing is if someone had like their conversations with IR in like one of the like their saved transcripts of the emails with investor relations. That'd be so sick. Damn. Let's just say high expectations for this model because you are a god. Alright, let's see here. Keep it all Arial and 10, please. Very nice. All right. I don't know that I need this. A little superfluous. Got the guidance. Oh, look at this. It's got all the acquisitions and all the press releases for those acquisitions. Nice. Very nice. Oh, come on. Flattery will get you nowhere. Flattery will get you nowhere. $43 million renter-occupied households in the U.S. Where do you get that data? Okay. Pretty good. I'm going to use that in my model. Thank you very much. You know it's good when I'm copying from your model. That's when you know you're doing a good job. All right. Here, let's see here. List of property management software. Cool. Buildium.
This looks like a serious competitor. Potential competitor. The RDV real page. A lot of you guys make the rookie mistake of thinking too hard about competition, and it doesn't really make sense. So I'm just going to show you how to format this thing. Some basic formatting advice for my models. Always keep zoom at 100%. Always. Always Arial and 10. Always have an empty A column. Always have an empty first row. Always freeze panes at I guess C3, wherever it is. There shouldn't be a space in between here. And always bold revenue. No superfluous words like total revenue. It's obviously just revenue. Okay. Should be a space for the years. Guidance, you should have put down guidance, and you've got the, it's weird, I thought you knew that there were, you have them missing guidance. This doesn't make sense. They also gave Q1 guidance. I think they said 127 for Q1. Yeah, 125 to 127 for Q1. You have that, but you don't have for the annual, which I thought I guess pretty big mistake. Sorry, Harris. No taxes. No interest income. Man, you're breaking my heart. And you don't have much margin improvement, but you don't have G&A growing too much, which is good. Your product development, you just keep it at 15%, which I don't think makes a lot of sense. 34 bucks a share is where you came out, which is good. Let's check the primary research.
5%.
You could just multiply it by 0.105. This is a weird formula. So I think the model is not very good. Oh, that's cool that you read all the press releases. Management's revenue predicting ability looks pretty good. I like that you put that in there. You did the green door. I don't know what green door is. Glass door, maybe. And excerpts from 10K. So, should forecast revenue based on customers, ARPU, etc., not arbitrary numbers. I'll give you a B+. Alright. Looked good at first, but model kind of sucked. Alright, Steven Chung. Yeah, just copying and pasting the Glassdoor ratings I don't think is any good. I mean, you wanna read the Glassdoor ratings. Yeah, I read the competition thing as well. I don't take competition too seriously. For a growing business, I'll get to that some later date, but you guys think too hard about competition. It's a rookie. A lot of rookies do that. This is good. All pretty good. All right, model. Ah, very nice. RPU. Very nice, very nice. Ah, beautiful, beautiful. Very nice. Ah, here's where it all falls apart. See, you have the kind of something weird happening to cash flow starting here. Let's see if I can pinpoint it. 60% margins. Yeah, you have 18%. Here's the mistake. You have S&M spending growing unabated, but you have revenue growth slowing down. That doesn't make any sense. And then the same thing for their other costs, like R&D shouldn't grow that fast. It didn't grow. Look at how much it grew from 15 to 14. Not that fast. So your operating cost forecasts are pretty bad. Not very thoughtful. You got the interest income thing right, which is pretty impressive. Taxes, again, 35% is probably too much. And yeah, anytime you do a model like this, and remember, the bulk of any model is going to be a function of the tail. And you just see that your tail numbers are wrong. It doesn't make any sense that in 2024 with 1.4 billion in revenue that they're actually going to have less net income than in 2016 with 500 million in revenue. Does that make sense? Doesn't pass the smell test. So great work in general, but total fail on the MPV, which is the most important thing. Otherwise would have been an A or A plus even. Poor Steve. Little to no apparent thought in operating costs. Forecasting. Okay. Let's look at Michael Flanagan, who is a real boss. Let's see if he did any good. Ah, he was so far the only one who found these these segments. Very nice, Michael. Very nice, very nice. I'm impressed. Great front page. Probably the best one yet. Let's look at the model. Very godlike. Pretty much a god here on revenue. How about costs? This number doesn't seem right. They're G&A excluding DNA. Interesting. How do you do that? Very unique. This is really good. This is really, really good. Although, you don't really talk about what goes into your units and your assumptions on this stuff. But you do get the point that the EBITDA margins are going to grow dramatically. Or the margins in general. Very impressive. This shows that simplicity is, this is a really simple looking model. It's not too intense. It really is really quite good. And it turns out that the NPV is closer to accurate than most. I'm impressed. I don't love the percentage of revenue forecast. They're kind of a little... One, they're a little off, and then two, they're just soppy, but pretty nice. Pretty nice. And I'm going to give you an A minus actually, because the DNA, subtraction, while creative, doesn't really make sense since there are cash CapEx costs. So that really didn't make a ton of sense to me. So it's a little bit of a mistake. I mean, CapEx does matter. It's not like you can just ignore CapEx. So anyway, not bad. All right, let's see. Aki. Jesus Christ. Wow, all right. Remember, stay at 100% zoom, or young Metro won't trust you. So they have top 10 out of 10 customers, which tells you something, I guess. Tendency for inorganic growth. True. True. Very nice. Very nice. Yeah, I don't think customer deposits is necessarily debt, unless that deposited cash is in cash as well. And I don't think it is. Be weird if it was. But we don't have to worry too much about that stuff. Okay. Customers are REITs and property management companies, large staff. Millennials are broke, prefer to live in metro areas and choose to rent over buying. CFO is on the verge of leaving the company. Interesting. I don't know that. Where'd you get that data? Appfolio is a public company. Excuse me. Huh. Very nice. This is mislabeled. Or no, it's not. It's not. Very nice. And again, you know, for the growth, you just have some seemingly arbitrary, but how about margins? Did you get that right? Let's see, they're 75 million in cash or net income on 700 and triple that on double the revenue. That's smart. Good. $31 stock. Good. Very impressive. Very impressive. I really don't have a... I mean, the only thing that I'm a little surprised by is you have 5% ARPU growth, so you don't, you know, but it'd be nice just to explain why you chose these growth numbers, but they're obviously very reasonable. For margins, you have 60% gross margins forever. For R&D of reasonable, no sort of synergy for G&A. It's pretty good, if I do say so myself. All right, you get an A. Very nice. Jason Yan.
The Fools.
I mean, you say it's a crappy company, but you have you have it growing a lot.
These forecasts aren't particularly good or impressive.
Well, wait a second, maybe. I think the cost forecasts are pretty crappy. It's pretty good. Alright, he doesn't like drones. It's nothing to do with real page. And this is a little awkward. So the commentary is a little bizarre. Let me check one more time. That's pretty good. Good job, Jason. Alright, Michelle Chow, I guess. We never get models from the ladies, so nice to see. The first person ever to actually get the exact same, 6 fundamental 6 things than anyone. This all very good. Ooh, I like this. I'm going to copy that into my model. Very good. All right, let's see the model. Just arbitrary growth. That's not good. How about GMA? That's pretty good. Why does it say Mike? Are you Mike or are you Michelle? I guess you're probably like French or something. Michelle could be a name and a man's name, I guess. All right. This is definitely a woman, Amanda Y. Feel free to be harsh. Don't tell me what I'm free or not free to do. Don't ever tell me. This is good. Very good, actually. Very nice front page, but don't ever tell me what to do. Although, you know, I don't understand why you've never heard of a decimal or values in millions. Alrighty, let's take a look here. Yeah, this isn't good. They're wrong percentage numbers? Yeah. Well, at least with growth amounts, I think that's they're not percentage of revenue. You don't know how to project, then I don't know how to give you a job. Get out of my face. How about that? How about that? What happens in 2030? World ending forecast? Maybe you should tell President Obama that you think the world's going to end in 2030 because I think there's graver implications than just the end of RealPage's business. So you think at 2030, their revenue will go from $1 billion to 0 the next year. That's basically what you're saying. Think about how stupid that is. Think about how stupid that is. Just evaporates. I don't care if she's in high school, grade school, or any other school. I like the fact that you got the margins right. Expanding margins. I don't know why you have the G&A going down. It's a little weird. Give you a C. Not bad for a first try, I'd say. Not bad for a first try. All right. Real CLCL. Is this Cal? Ooh. Did he give me 2 models? Because I don't see 2. Look at this garbage. Huh. I like that. I didn't know that about the board. That's really cool. The board is required to own 3 times their salary in shares within 4 years of joining. That's really impressive. I didn't know that. NWP acquisition was smart. Very nice. All right, let's get to the... Whoa, 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 whoa. is this?
The hell is this? The hell is this? Wow.
All right. Yeah, models aren't about complexity. Models are about just accuracy. But yeah, Calvin, you need to find a dumpster to work out of because you're not working for me anytime soon. Get the hell out of here. All right, Sultan. What the heck? All right, this is trash. This is just trash. Ken Fitzpatrick. Nice waspy name. Check. Oh, I didn't know he owned some of the stock through a fund. That's interesting. Did not know that. Yeah, let's take a look at this. Just arbitrary revenue. Too arbitrary for me. Need ARPU. Founder 68, huh? Luigi. What the devil? You're supposed to make these things so I can read them. Look at this. You just move this stuff over here. It's what the heck? Again with the arbitrary forecasts. Good. I don't know why you put your age here because I don't really care how old you are. I was doing quality work when I was your age, so get out of here with that. You don't get any sympathy from me. And only a sucker would want that sympathy. You Can't compete with the big boys. Stay out of the kitchen. You forget that they gave guidance that's higher than this? I don't know, man. Are you feeling that? Some respect on it. You don't have margins going up too much. Yeah, some of this doesn't, the cost structure that you're forecasting doesn't make sense. And your revenue is arbitrary. That was more or less trash. But I'll give you a C minus. Goggy. If I get trashed again, I'll sleep in a dumpster. Wow. Well, hope you found a dumpster you're gonna like. Goggy. Alright, let's see here. Are you ready for the dumpster? It's not bad. Key growth drivers sell more units. They don't sell units. They sell software. Base model, upside model. Okay, he only does annuals. That's nice. Just picks a random number to grow revenue by. No need for any realistic forecasting. Who cares? Just pick a random number, 15%. That sounds good. And how about margins? Oh, you add sales, general, administrative in one column because that makes sense. This is close to trash. Yeah. Whoa. Questions for Akil. God damn. Oh, that's that. Oh, this is a. Oh. This is Akil's brother? What? You paid your brother to do this for you? What the? What a boss. What a boss. Amazing. Okay, nice, nice. Nice. Very nice. Very nice, very nice. This guy is a boss.
245 is dreaming. Yeah, it's pretty obvious that it's dreaming though. The TAM is misleading, fair enough.
They rejected a buyout offer for $2 billion. I didn't know that. Wow. The RD versus RP software, right? The other guy found that too. Damn impressive. Huh. Well, maturity growth is pretty handsome. That's the only thing that I think's a little weird. It's very conservative. Yeah, that's really good. I mean, I disagree with the premise. The conclusions. But yeah, so maybe, but it's definitely the best model. Yeah, I'd say it's the best. All right, I'll get through the rest of these real quick. Roman. Pretty much trash there, Roman. Sorry, bud. Max L.
Yeah, so with scale, like, if you have a $1 billion company and you're only making 10% margins, you got to ask yourself, why be in business? Sell your company and get rid of some of your costs, you know? Or acquire more companies until you can get a real margin. This is just, doesn't make sense. Doesn't make any sense. Wilhelm. Pretty good. Yeah, I never want to see like a best case model and a worst case model. It's not really a good idea. But that was pretty good. Alex? What the hell is this? The hell is this? Oh, here we go. Okay. Yeah, you don't get the margin thing either. You're not going to have a $3 billion revenue company with $200 million in income. Doesn't make sense. Why have a $3 billion revenue with $200 million? That just doesn't make sense. Wow, you guys sent me a lot of models. Okay. Okay, appreciate the comment, Isaacs. Okay. Yeah, you don't have the scale right here. Note to self, start a real estate SaaS company and get acquired by RealPage. That is hilarious. Ooh, you've got some lawsuits here. Nice. Sheriff Tam is a bad way to. Very bad way to forecast. Zach Hartenberg. Almost done. Just reviewing models. Couple more left, 3 more. Thomas. Don't expect great things. That's not a good way to introduce yourself to me. Time is our most valuable asset, yet we tend to waste it, kill it, and spend it rather than invest it. Thank you for spending your time on my model. You're welcome, Thomas. I like that you have the product lines here, very impressive. I'm actually going to copy that to my model. That's how you know you did a good job. Someone else did the same thing, but it's pretty good. Got some competitors here. Dinosaurs. Management is dinosaurs. That's not good. Yardy seems to be a serious competitor. Alright. Let's check this model out. This is actually the format that's closest to mine. Good job. Scale, well, looks like you kind of get it. Sort of. Yeah, you got revenue. Yeah, too arbitrary. Alex, I think we already looked at yours, right? Yeah. Good. All right, Alexandros. Last but not least. We are done with all this stuff. Poorly managed company? I don't know about that. Maybe. Nice. Yeah, you got the margin thing wrong too. All right, so you guys sent in 30 full financial models, which I looked through every single one of them. I am impressed with myself, which I wouldn't normally say, but great job in general. Only 3 got trash ratings, and we got a bunch of pretty good models. Akil's brother's model, I guess, was by far the best. Not by far, but really impressive. Aki did a good job as usual. He's very qualified. Mike Flanagan did a good job. Ben Goldstein, definitely the most creative model I've ever seen in my life, which is saying something. Definitely saying something. Harris, he did another good job. You're really impressive to me. Jason Yan did a good job. Wilhelm did a good job. So you guys all, I thought, did a really good job. Top 5, top 6, really impressive. I'm going to, unless Akil, you want to veto it, hold on 1 second. I actually want to buy the stock on Monday. So we bought a little stamps.com, and I want to add RealPage to our portfolio. So if Bad Boy, Akil, or Aki, any of you guys, Mike, we're thinking about promoting you to partner one day. So consider that. This is the A+ model, my model. Let's see, who else did a great job? Yeah, everyone here is being recognized. Jason. I don't know. Do you guys want to veto it? All right, 2% position. Akil, no veto. Bad Boy, what say you? Harris. Okay, I think we're gonna buy some stock on Monday. So we'll buy 1,000 shares, roughly, and we'll see. Yeah, of course I'm buying stock. We'll see what happens from there. So I bought stamps.com. We'll try to buy RealPage, and it's $1 million basis portfolio. So we'll see how it goes. So thank you so much for joining. I hope you learned something. We'll see you next week. So for next week, I want you all to look at a stock. See, what stock do we look at? Let's do a company called Make My Trip, MMYT, MakeMyTrip.com. It's definitely not a software company. So we're gonna have to do enterprise software too, since we were doing RealPage. It's not really a. All right, let's not do Make My Trip. Hold on, Make My Trip is a foreign company, so I'd rather do something else. Let's do maybe Groupon. Groupon. Yeah, let's do Groupon. Groupon is also pretty controversial. So, GRPN. Here's the instructions. Send a GRPN model. Send your model to Shkreli. ryan@gmail.com by 4/30/16, 6 o'clock p.m. Eastern Standard Time. Make sure your revenue forecasts are not arbitrary. Make sure you follow the preferred formatting. And yeah. So Groupon is the company we're going to look at next week. And if you tune in during the week, I'll be around like updating models and doing stuff. Like I wanted to short Netflix. You guys, let me show you what I wanted to do in Netflix. So I updated our Netflix model, and I was very alarmed because the company's cash flow is so terrible. They were losing another quarter billion dollars this quarter, and their ads was very much below expectations. So they're only going to add 2 million customers next quarter, which I don't think is very good. I have to fix the penetration numbers. But the point I'm trying to make is the company has 80 million users and they still lose $1 billion a year. So I'm not sure the company's worth $40 billion. So I'm going to short 50 basis points of Netflix on Monday, and then we'll keep working on it over time. All right, so thanks again, everyone, and I expect your Groupon models next week, and I really appreciate your time. I hope you learned something, and we'll catch you later. Bye, everyone.